The broadcast is now starting. All attendees are in listen-only mode.
Good day, everyone, and welcome to the Merchant Tech Mid and Small Cap Quarterly Update. My name is Janelle Zamela, and today Brian Rayner from Merchant Tech will be presenting. But before I hand over to Warren, to Brian, I just want to go over a few house rules and also check that you guys can hear me. So if you can hear me, could you please indicate that you can using your digital hand. It'll be the little hand icon near your username. Okay, perfect. Great. So I'm going to hand over to Brian in a moment. Just to be sure, Brian's going to go through his presentation. You are welcome to send questions during the presentation, but we will do question and answer session straight after his presentation. So he'll present one way, and then once he's done, I'll look into the questions, and Brian will address them as we go through. All right, thank you very much. Brian, over to you.
Thanks very much, Danielle. Appreciate it, and welcome everyone to this our second quarterly update for the year. As introduced, I'm Brian Rayner. I'm the Director of Research for Merchant Tech and have been covering most of these stocks for the last 15 to 20 years or so, along with my team of 3 analysts. Right, so into it straight away. Let's just have a look at the general economic conditions that have been affecting these mid and small cap stocks over the last quarter to 6 months of this year. And I think, unfortunately, what we're seeing, and this is reflected in a lot of sentiment studies, etc., is that the initial rumaphoria has somewhat diminished. And as someone quipped, you know, there definitely is light at the end of the tunnel. However, the train is quite seriously off the rails, and there's a lot of work that needs to be done to get the train back on the tracks before we can even start approaching that light at the end of the tunnel. And I think that's, you know, in my experience of speaking to a lot of CEOs out there, the feelings that are being expressed. So there is optimism, but an understanding that there is a lot of work that needs to be done. And that's reflected in the sentiment of most of the prospects of the CEOs that we've seen giving their results over the last 3 to 4 months. So just reflecting that in the harsh realities, first quarter GDP contracted quite significantly in our major areas of mining, manufacturing, and agriculture. We've seen heightened currency volatility, slight weakening of the rand. As I mentioned, business confidence is still trailing at all-time lows, although there has been some pickup in some areas. And we continue to face political uncertainty, especially around land reform, the mining charter, etc. And further to that, we now have the prospect of the general elections coming up, and that always starts having an impact on business confidence, investment, etc., and just leads to protracted buying cycles with companies, which again, unfortunately, puts companies' performance under pressure. We also have the ratings downgrade hanging over us as something that also affects people's confidence and the general cost of capital. Furthermore, we've seen the consumer segment coming under some pressure, and we've seen that with the results of a number of the consumer-facing businesses, some of those that previously had been quite defensive in the food sector, for example. And we've seen that shown in the retail sales, which are down quite significantly in April, well below market expectations. At a broader level, we see globally tensions led by the US, and that is having an effect on emerging market currencies and the risk for appetite in emerging countries. As a result of that, we've seen some valuations fall off fairly dramatically as investors are getting very nervous, and they tend in those instances to look to quality or the larger stocks, and in particular for some safety in rand hedge stocks. And typically that means that the mid and small cap stocks, which are typically seen as having slightly higher risk, tend to take a bit of strain in these particular environments. Although on an individual basis, you might even find small cap stocks are less affected by the general economic conditions, given that they are niche or very defensive in what it is that they provide to the market. And those are the companies we like to look at to see, where the valuation upside is. And you can see some dramatic rebounds the moment confidence returns. So if we have a look at the price changes year to date of the companies that we cover, you will definitely see that there are certainly a lot more that showed a negative price performance over the last 6 months compared to those that have shown some positive price performance. And I must say, we're happy to say that a number of the picks that we made at the beginning of the year are in amongst those that have performed quite well over the last 6 months. And we'll get to those in a moment. So just a review once again of the top picks that we looked at the beginning of the year. There's Adapt IT, which is a niche IT services and software business. There's Afrimat, which is a specialist provider of resources and resourcing material, and recently an entrant into the niche iron ore mining area. Santova, again, a niche provider and playing in the logistics sector. Alviva was formerly Pinnacle Technologies, Pinnacle Holdings, one of South Africa's largest ICT players. And then a smaller company, Insimbi, which has done some fairly large acquisitions recently, which plays in the area of providing supplies to some of the major manufacturing industries in South Africa. So in summary, even though we've seen some fairly large price increases in these stocks, we're still happy with these picks and are happy to include all 5 of these in our portfolio as being companies that we think have got quality prospects and are undervalued relative to, I would probably say, larger stocks, and undervalued relative to the performance that they can deliver and will deliver in the next 12 months or so. And we're happy to hold those. And I'll give you an overview of those, along with one additional company that we think bears looking at, which we're happy to add to this watch list for the next 6 months. And then I'll share with you our views on a number of companies that are on our watch list that show they could show very strong upside, but there's a lot of risk with them, and a lot of them need to demonstrate something before we can understand that risk disappearing and seeing a subsequent price increase. So if we just have a brief look at a summary on the stocks that we picked for you at the beginning of the year. So Adapt IT, it's had an exceptionally strong recovery in its share price, around about 40%. And that was on the back of fairly strong results that it showed for interims, and a demonstration of continued acquisitive growth, even given the decrease in its share price that it saw towards the end of last year. Insimbi increased also quite strongly in the 6 months, and again that was on the demonstration of strong results, largely on the back of the completion of an acquisition that it had made, as well as acquisitive prospects and its relatively defensive nature. Santova, also nice results shown last month, and continues to show that it has a fairly defensive, sustainable business model, which is diversified fairly nicely globally to again show sustained earnings. And I think that's why we're starting to see the share price up, and why we think that it's a good company to continue to follow. Disappointingly, Alviva was unchanged really from a pricing point of view, and this is largely as a result of the muted operating performance that came through. Margins under pressure at interims. However, we do believe that there will be some recovery for the full year results to June, which has just obviously passed recently. And then finally, the disappointing and somewhat surprising performance from Afrimat, and that was again reflected in the price coming down some 16%. On the back of lower earnings and an overall subdued economic outlook. And we'll have a look at our views on Afrimat in a moment. So in summary, on a stock-by-stock basis, our merchant tech picks, we're very happy to say we've been quite fortunate there in showing about a 57% overall return if you'd invested in each of those particular stocks. And that compared against the mid-cap JSE index loss of 13% year to date, and the small cap and JSE all-share index showing around about 7% losses. So if we now move into our stocks for a bit of an update, and we presented these to you for some time. So I'm not going to go into the absolute details of them, and I will refer you also to the Standard Bank website. We do publish detailed research notes on all of these companies, which are a 3 to 4 page analysis of results, an explanation of our assumptions, and details of our forecasts and how we get to our recommendations. And those are available in perpetuity on the Standard Bank site, and you can access them there. So I'm going to keep it fairly high level and really just concentrate on where we see the investment thesis for our top picks and those continuing to show value. So Adapt IT, what we really like about Adapt IT is that it's a leader in the South African ICT market in its particular niche areas of education, manufacturing software, energy solutions, and in the financial services and hospitality sectors. It's
sorry,
Brian.
Brian?
Sorry, I forgot to change the slides.
Yeah.
Okay, sorry everyone. So very quickly, the price changes that I spoke to, you can see the. I mentioned that there were a lot more losses than gains, and these are the 6 companies we're talking about. I spoke to the price improvements and relative performance to mid and small cap index, and I'll be showing most of these figures again, so you'll be able to pick them up. Sorry about that. So Adapt IT, as I said, is a leader in the South African ICT sector in its niche areas, gaining critical mass, getting up to employing some 1,000 people, and put that in the context of where it is. It's about a 10th of the size of an EOH. What we like about Adapt IT, and we've been following them ever since they really came to the stock exchange, is that they are a relatively conservative management team that's very focused on its core, the core businesses that it wants in its portfolio. These businesses typically must have a lot of IP in them. They must be in a niche area. They must be the number 1 or 2 player in that particular area. They must be high margin, and because of that, they must be very sticky in the client bases that they sell into. So it's very difficult for, once customers have actually got them installed, either not to pay or to get rid of them as a service provider. And what we've been encouraged with is that not only have they selected those businesses very well, and we're seeing, the results and earnings coming through, maintaining high margins and being defensive even as the economy gets very tight. We're seeing that the acquisitions that they made always need to fit into these particular criteria. So unlike the EOH model, which has come under quite a lot of criticism and stress at this point in time, where we saw, and it was a legitimate strategy at that point in time, where they were really providing a major aggregation role in the ICT sector. I mean, they made some 300 to 400 acquisitions over a period of 10 to 15 years. They were less judicious and rather brought it into their portfolio with different criteria. Adapt IT, being that much smaller, can afford to be a lot choosier around the acquisitions that they make, and yet still show some relatively high growth. And that's why you see in our forecasts, we're looking at some fairly significant revenue and earnings per share growth. That'll be on the basis of both organic growth, probably in the 15 to 20% range, and then acquisitions making up the balance of that kind of value. If we look at the valuation, we're seeing value at around about 13 Rand or so from the current levels. They were at a recent high in January 2017 of around about 16, and went all the way down to a low of 6 Rand. And I think that was part of a contagion of what happened with the EOH, as well as some disappointing results along the way, which had some exceptional reasons for them. So 12 Rand's kind of sitting midway between the low and high, and where we actually see value on a relative PE basis. And it's the reason as to why we're happy to continue to keep them in our portfolio. Moving on to Afrimat, as I mentioned initially, we were somewhat surprised by the disappointing results that they showed after, many years of earnings growth. This was the first time that we saw a decline in earnings growth. And there were two major reasons for this. The one is that they are actually seeing the government spending on projects has been severely down. And we're seeing this, with a number of the construction companies coming under immense pressure. We're seeing big companies liquidating. And that is unfortunately a function of the South African fiscus not being able to actually bring project finance and to actually get projects paid for at the moment. So Afrimat, to a certain extent, has had some shelter from that, in that it's had ongoing roads projects over the years, but these are coming under pressure at the moment. They are somewhat diversified in that what they supply is also into industry, for example, their limestone products, other quarry materials, and they do have a geographic diversity that does provide them with some defensiveness. The other big disappointment that we saw, and I think the market had been anticipating, that their iron ore turnaround operation would have started producing some revenue, but they were again presented with a problem when Transnet couldn't actually get the iron ore out of to the ports and where it needed to go. Management are fairly confident, although can't say with any certainty that this is behind them, but nevertheless we have brought into our forecasts a return of the Transnet logistics capacity and earnings to flow through from the Demanning acquisition, and that coming through in the next 18 months. We continue to rate the management team, its conservative nature, and yet its ability to do good acquisitions. And on that basis and our forecasts, we see that there is still value in the share, and we believe that the moment things start picking up a bit, this will once again be a share that the market enjoys supporting. Santova has done quite well since January. We've liked Santova and we've been covering it for some time. Again, its share price has come off a bit over the while, from a high of around about 4.60 in January 2016, and a low of 3 Rand as late as April 2018. So it's recovered quite nicely up to 340 or so, and we believe that it's got further price potential over the next 6 months. Essentially, what we like about Santova is, again, it's got good, strong management who've been with the business for many years, and they have managed to diversify their portfolio beyond just South Africa. And they're taking what they've understood in South Africa and taking that model into a very well-planned and yet structured international expansion in the logistics space. We like the fact that they don't have assets. They're not a logistics assets place, and they don't own trucks, they don't own warehouses, they don't own any other assets to support themselves. And they are a 3PL, or a third-party logistics service provider. And they're busy looking at smaller businesses that they can just add into their network in the different geographic jurisdictions around the world. And there are a lot of businesses for them to be able to acquire and bring into their network in that respect. And we see logistics is a business that is globally is one that has ever increasing volumes, and they're well positioned in that space. So they're currently on a relatively low PE of 6 times, a forward PE of 6 times, and we think, at a revised valuation of forward PE of 7 is not that demanding, and we would still see that there's some share price potential for Santova. So we're happy to keep it in the portfolio. Alviva, previously Pinnacle Technologies. Let me remember to move on the slide. So they're one of Africa's largest providers now of information and communications technology, both hardware, software, and services through the various acquisitions that they've made. They're getting close to 13 billion in revenue, which makes them one of the largest remaining listed companies in this space. They have got a very solid management team who's been in the distribution business for 20 to 25 years, who understands the South African environment intimately, and the exposures and levers within the South African economy. They're good operators. Their challenge remains in trying to move the margin up in the business, and they're doing that through very selective acquisitions. They have had some challenges, reputational issues 4 or 5 years ago, which meant the share price took a big knock, and that derailed essentially their acquisition strategy because they couldn't use their paper to make acquisitions. But we see that largely behind them, and we see that reputational risk has dissipated somewhat with new management and new structures in place around corporate governance. They did show a disappointment at interims around, so whilst revenue was up, their margins came under some pressure given competitive environments. But we see that recovering somewhat in the next 6 months. And as one of the largest players in South Africa, people still need to invest in IT and IT services and hardware. And so, on the back of that, we see IT and the kind of services and what Alviva provides as being fairly defensive. IT and IT spend is just a must-have in South Africa, and they're a major player in that area. And they're supplementing that with new ventures into energy solutions, etc. So applying the head office understanding what they have in distribution businesses and getting into some slightly higher tech, higher margin businesses. So again, they're on what we believe is an undemanding PE of around about 6, and we think there's room for them to improve over the next 6 months, and we wait to see how their final results for the year to June come out in a couple of months. Their last high was 22 Rand around about March 2017. And then finally, in our portfolio, we had another small company which we'd highlighted for some time. Again, showing a good price increase over the last 6 months, is a business called Insimbi. They're a specialist business that provides materials into the steel, aluminium, cement, and foundry industries. And as such, even though commodity prices might be down, what we see is that volumes in these businesses still need to continue and don't necessarily decrease. And therefore, the use of consumables in these industries continues, and demand for them continues to grow. Obviously, they do come under pressure, given that their clients are coming under pressure. But largely, again, we see Insimbi as being a relatively solid defensive business. What we've also liked about it is that it's done some very earnings enhancing acquisitions. And you tend to see with some of these small cap players that have been listed for some time, and I think Insimbi's been listed for at least 10 years, eventually they do start to get an understanding and the ability to make value adding acquisitions. And there are a lot of companies out there, specialist niche companies, which are attracted to come into a listed entity. As Insimbi, although it's not very highly rated at all, it can still raise capital and or do deals by placing paper. And they bought Amalgamated Metal Recycling, which significantly added, almost doubled or even more, their revenue over the last year or so. And we see the effects of that still coming through with margin enhancements, and as they bed the acquisitions down and eke out some of the synergy. So we're seeing our headline earnings per share forecasts being relatively high for the year. Again, an undemanding forward PE of 5 in this environment, we think is quite harsh, and we would expect and feel that it's better placed relative to some of its peers out there at a lower discount than it currently is trading at, and see value closer at the R1.65 level, which is somewhat higher than its high, which of R1.56, which is in October 2017. So that covers our portfolio of our 5 picks, and we're still happy to keep those in the portfolio for the reasons that I've outlined. Going through our ranking table, we've picked up that Clover is a new stock pick that we'd like to bring, and we bring it because we think the risks are relatively low and the potential value uplift is fairly substantial. Clover over the last couple of years has been through major restructuring, and the areas that it's been restructuring is to really get out of being a milk provider per se, and to get away from being exposed to the commodity cycle of milk prices. And they've structured a deal whereby they have moved their exposure mainly from being exposed to the price of milk to being a service provider to the large milk producers. And they really are then just leveraging their ability to deliver the logistics function and to take a fee on the back of that. And on the basis of that and cost cutting and restructuring and new ventures in yogurt, etc., we see that their earnings should stabilize somewhat over the next couple of years. Our forecasts, to give you some idea, you see that we're saying that there's a massive increase from 64 cents to 218 cents per share, but that is last year's was a disastrous year, and there were a lot of once-off costs and expenses that went through on the income statement. And this performance of around about R2 per share really reflects probably a doubling of what they've already achieved at the interim level. So it's not that much of a stretch. And we think the market hasn't quite appreciated that yet, and they may very well still be looking backwards at last year's performance. So on that basis, again, we see them on a forward PE of around about 6, which we think again is undemanding. And if you compare them to some of the other large food producers out there, which are not doing as well and who are rated on much higher PEs, we think they deserve to be higher rated, and that there's potential for the share price to increase fairly significantly. They were trading as low as 12 Rand in December, and got up to about a 20 Rand share price in March 2017. So we're looking for some outperformance from Clover over the next 6 months as they bring out their results and demonstrate to the market a repeat of the interim performance and the benefits of the cost rationalization that we've seen. We then move on to the to what I've called our speculative buys and watch lists. And if I just fast forward to our ranking table, and I must mention once again, you know, all of our research reports are available on the Standard Bank website, and as will this presentation be available, so you can go in at your leisure and have a look at our assumptions and the details of, for example, the ranking table over here. You'll see there are a number of stocks here where we're forecasting significant potential gains. So there's the Silver Bridge of 80%, Taste of 60%. We've spoken to Clover, DAPS, EOH 40% recovery. There's a Meta here there around about 40%, Cartrack 25%, etc. And I'm just going to make a note on some of these. We haven't included them in our portfolio because we believe that there's still, whilst there's this high return possible, there's still high risk associated with these stocks. And there's with each of these, there's some kind of trigger event that needs to happen. And that's either around timing. So we've got to see if what they've said is going to translate, or we've got to see a direction. You know, are things changing? Is there momentum behind what's happening? And typically we can only really see that at results time. So EOH, and obviously there's been a massive disappointment for a lot of shareholders, seeing the share price tumble from 1 Rand for 170 down to 25 Rand or so. We really do believe that there's a recovery in the medium term of the stock to at least say the 50, 60 Rand level. We've revised our earnings growth downwards for FY18, which will have just been done now. But we do see a recovery in FY19. I mean, it's the business which has been around for many, many years. It is well managed. The big assumption around here is that acquisitions can continue. And, you know, talking to management, they are still saying, yes, we really believe we can continue to do the acquisitions. And acquisitions is not just acquiring companies now, but it's acquiring new business on new ways of doing business, for example, big outsourcing contracts, etc. And they remain relatively confident. I think, however, you know, they've taken a knock, and earnings did take a big knock as well. And market sentiment has changed. I think people are very nervous given what's happened with Steinhoff, and so they're tending to paint EOH with the same brush, saying it's also an acquisitions-based model, and which requires a very high-rated stock in order to work. And that is somewhat our concern, is that, you know, the rating on the stock, its PE, its ability to actually place shares to do deals has been severely limited now, especially if they really want to go offshore. So they are in the process of looking at raising cash through debt. They're looking at doing a BE deal, and I think this is also what's making the market a little bit nervous. They don't know what the costs of that BE deal are going to be. They don't know if the funding is going to come through, etc. However, we believe that the fundamentals of the business have got earnings power in them. Again, refer back to the comments I made on Adapt IT. So again, we would say one needs to have these on the watch list and keep close to the news flow, see what happens at results time, and it's the kind of stock that could rebound quite quickly and recover to some way to its previous highs. Silverbridge is a small company and shows relatively volatile earnings and volatile share price, but at a forward PE of 3 or so, it's just extremely cheap, and has delivered some fairly good earnings growth over the years. And what we've seen is when it does that, the share price reacts. So in our forecast, we've taken into account the fact that we saw some decline in earnings coming through, and they've made a trading statement in that regard. But even so, a PE of 3 is very cheap. Just a caveat on that, it is very small and it is relatively illiquid, so one needs to take a bit of a position and to be patient, to wait for a couple of years. It's not a quick in and out kind of stock where you're going to see your money back. Taste, again, has been a big disappointment to a lot of people. I think some fundamental errors were made with Taste. The expense of the conversions of the old Scooters pizza business to Domino's, the lack of take-up by the previous franchise holders for Domino's in South Africa, an underestimation of the South African market for the Domino's brand, the strength of the current players, both new ones, like Romans, etc., that are doing quite well, and Debonair's, I think, was underestimated. And the overall costs of implementing and getting the stores up and running was underestimated by the previous management. If, however, with their new major stakeholders, they can afford the additional rollouts of Domino's and Starbucks, and I think they've got close to a break even with the number of stores that they're getting to, and with some continued cost cutting and focus, then I think long-term recovery is possible. But we don't know to what extent the funding is still required to get these businesses to a break even, and what the resources are that they have to do that, and therefore it remains quite high risk. New management, understandably, has been quite reluctant to talk to the market, so there wasn't a results presentation for us to really gauge what's going on there, and we'll have to see again how things pan out. It's a bit of a digital outcome at this stage. It's almost at the betting stage. Metair, again, it's a business which over the years has shown relatively volatile earnings, but given latest results and our projections, we're relatively confident on what is out there, and again is showing up with value, with it, for a large company only being on a forward PE of around about 6. It is in the process of evaluating a very large acquisition in the battery space, in the international space, and management have come out in a cautionary, actually advising that they believe that the market reacted somewhat negatively to that acquisition. So that is a bit of a flag. It looks like it's a very large deal, and the process is underway, and we'll need to understand more of that deal and its implications and its financial impact on the group going forward. So again, the business is looking relatively cheap. It's a big business. It's internationally diversified, etc. It does tend to be a bit of a business where one part of the business does well and another does not so well. But so it's a diversification which has helped keep the business going, but we have yet to see all businesses firing on small pistons, as it were. We've then included Cartrack. We're still seeing value in Cartrack. It's been a long time favorite of ours, and share price has shown some good improvement. But what we'd say there, it's relatively expensive in SA small cap terms. It's on a PE of let me just have a look here, of around about 16, which is high relative to the other small caps there. But if you look at the international peers of vehicle tracking and fleet management businesses, the PEs are certainly a hell of a lot higher. And if anyone was ever interested in acquiring Cartrack, it is a globally attractive kind of business, that's where you would see a large value unlock. So again, that's why we're saying it's potentially a speculative buy and sitting there on our watch list. Again, you need to be careful. It's very illiquid and relatively small, so you'd need to take a longer term position for it. And then finally, another niche business in South Africa that's relatively defensive is Interwaste. It plays in the waste management and landfill space. Again, it's looking reasonably cheap, and we're reasonably confident on our forecast for the year, which will underlie why we're saying it's looking relatively cheap. And again, you can go and look at our reports on these businesses to get more details. Again, be aware it is relatively small and liquid, and you need to be patient, but it's an interesting business to bring into your portfolio. So in conclusion, I'd like to thank you for your attendance and for listening to me. I'd like, again, just to say reports are on the website for more details. And I'm happy to take any questions that you have right now. I would just refer you to our disclaimer, which again is presented here and is available on the Standard Bank website. The major caveat of that is that investors need to take responsibility for their own investment decisions. Okay. Danal.
All right. Thank you, Brian.
Are any questions?
I don't see any at the moment. So do you perhaps, while I give people an opportunity to send their questions through, do you just want to go through how people can contact Merchant Tech if they'd like, to get a view or follow up to the presentation?
Yeah. If they would like to, they can contact myself. It's brian@merchanttech.coza. And details of other contact details are again published on our research reports, telephone numbers, addresses, etc., where they can get hold of us.
All right, perfect. I do see there's a question here from EJ, and he wants to know, what is your opinion on cash build?
Unfortunately, I'm not up to speed with cash build at the moment. I can't really offer an opinion on that directly. In terms of our current valuations, though, by our analysts, we've got it as being at value. And unfortunately, that's about as much as I can say on that one. Sorry, EJ.
Okay.
I think they've just given their latest quarterly update, and which will be obviously followed by results, and we'll get our report out on that as soon as that's available.
Okay. Thanks, Brian. I don't see any other questions. So I think we can wrap it up. Thank you very much, Brian, and thank you everyone for joining us. And as always, if you guys would like to see more of the Merchant Tech reports, they are available on the Standard Bank Standard Online Share Trading website, and you'll be able to find them under the research portal. Thank you very much, and do have a lovely day, and thank you very much, Brian.
Thank you. Thanks, everyone. Cheers.